So we start. Okay, so this is just an example which I'm just doing, a simple one to explain one of the concept. So whenever there is a new project, okay, and the lenders give loan to the company, then they have certain agreements to make sure that their loan repayment is done on time, and there is no kind of a miss out on that. So example is that the project has, I've shared this file also again, okay, और सेकेंड वाली नहीं आई, बट ये पहले आपको शेयर करिए, उसमें है ये जो आज मैंने भेजी है वो आ गई आपके पास, that Excel sheet that you have shared. Okay, this I'll also share again. I have added something, so but this is already there. Okay, so can you see this slide on your PPT, earlier PPT which I shared? Okay, but anyway, if you don't have, don't worry, it's just one small question I'm just sharing example, and then we'll move on to the Excel sheet, okay, which I have already shared and you have. Okay, I just, in the meantime, I'll just try to work out my WhatsApp so that I can set it on a WhatsApp group also. Okay, so a project has following debt service obligations. So year 1, 2, 3 is given, interest is given, and the principal. So this is the interest and principal what the company has to pay. Okay, the loan agreement requires a DSRA, that is the debt service reserve account. Okay, so it's a new term. So debt service reserve account is explained at the bottom, is a reserve of restricted cash maintained by a project to ensure timely payment of debt obligations. So that means, the company has to make a reserve. That means it has to earmark the amount which is supposed to pay next year and keep it in a separate bank account, which it can't use. Okay, so that ensures that they are not able to use the cash balance which they have for other than paying the repayment in the next year. Okay, so a loan agreement requires a DSRA equal to 6 months of next year debt service. Okay, fine. So Aditya, क्या वो नींद आनी शुरू हो गई? Okay, fine. Or you are just focusing and concentration and hearing me? I'll believe that. Okay, no issue. Calculate the DSRA required at financial year close year 0. Okay, that is one. Second, determine the DSRA balance at the year end 1. Okay, then state whether DSRA top up or release is required at the end of the year 1, because they have to maintain up. Okay, so this is the total debt service. That means the company has to pay this much of the installment, which includes the interest as well as the principal. The first year is how much? 100 crores. Second year 96 crores, and then 92 crores. So the DSA requirement, which is given at the bottom, is 0.5 into the next year debt service. So that means it has to keep 50 crores in the reserve account in the year 0 itself. Okay, next year they're going to pay this 100 crores, but at the financial year close of the year 0, okay, year before they are supposed to pay, that's the year 0, so they have to keep 50 crores in a bank account, which they can't use it for any purpose. It can't be used for any dividend or something. It can be kept only for repaying the debt. Okay, so if you look at this first one, this is the formula which was already given in the earlier slide. DSRA at the financial year close is 0.5 into 100, which is 50 crores. So that means the company needs to deposit 50 crores in a separate bank account. Okay, in the balance sheet, it will be shown as a restricted bank balance. In the notes to account, they're going to explain why this amount cannot be explained. So even how they are financially disclosed in the balance sheet, I'll share that. This is shared in the slide itself. Okay. Then in the DSRA required for the end of year 1, since 50 crores was already kept and they paid 100 crores, they will be paying 100 crores. So now they are supposed to keep 48 crores in the year 1, at the end of the year 1. So that means they already have 50 crores, so they can take out 2 crores from that bank balance. Okay, so they have to maintain a reserve of 48 crores to the extent of next year loan installment. Okay, so at the end of the 1 year, it will be 2 crores. They are going to reduce it from the bank balance, since they are already maintaining 50, but next year it will be 48 crores. So they are going to reduce 2 crores, and that can be, used for the purpose of, for the equity shareholders. So if you look at this, the final solution, okay, where at the financial close, first year 50 crores, second year 48 crores, and adjustment will be 2 crores, okay, in the second year, because they already have a balance of 50 crores, they won't take out, so they're going to reduce by 2 crores to meet out the next year agreement target. Is that okay? Fine. So if you Uh, so there's another question, so I'm just skipping that. We'll come back later on. So why a separate account is mandatory? First of all, logic. Lender's protection prevents diversion of funds. Cash discipline enforces cash waterfall. That means the cash will flow according to the requirement which is given here, from the revenue to operating account, then debt service account, then the DSRA restricted account, and the surplus is available for distribution. So anyway, so then we have so it complies with the agreement terms. Okay, ensures DSRA always maintained, and easy monitoring by lenders. Okay, now how do we show that in the books of account, in the balance sheet? So this thing appears as restricted cash on the balance sheet. Okay, disclosed in notes to account, not treated as free cash. Variations. Okay, now there can be some variations also. Sometimes DSRA may be maintained as cash DSRA, which we have already discussed, that restricted cash is maintained, or the company can say that we don't want to block cash. Okay, because it reduces their bank balance, so they are going to give a bank guarantee instead of that, or a letter of credit, so that the lenders can invoke the letter of credit if the company is unable to pay. Okay, so this is just a guarantee. So if the lenders agree, then a bank guarantee can be given to the lenders instead of keeping cash separately in a bank account. Okay, so normally the companies always prefer a bank guarantee. Okay, fine, हम आपको bank guarantee दे देंगे, don't worry, we'll pay you the money, and in case if we are not able to, you can just ask the bankers, they will invoke the bank guarantee, and you invoke the bank guarantee and they'll pay you the money. That's a rare kind of a situation. Okay, then yes, DSRA is maintained in a separate lender's controlled bank account as restricted cash exclusively for servicing the debt. Initially, I was thinking that it's a kind of a reserve, which we always make like depreciation reserve or any reserve, but it's not a reserve. Okay, it is the separate bank account where the money is kept solely for the purpose of repaying the debt. DSRA is a bank safety net, and that's why it is locked away. Okay, it's kept in lock. Okay, so I'm just moving. The rest you can just go through. Some more information is there regarding this. So I'm just doing this question now. So have you got the file with you now? So let's move on to the example. Okay, fine. So we are saying that there is a company which is setting up a 100 megawatt solar power plant. So listen carefully, because you will be doing a full-fledged question in this thing, and you can ask any question you want, and then you have to do another question which I will be telling as a class exercise, and then you just change the parameters of your own. You can make 100 watts to 200 watts, 200 megawatts. Everybody is supposed to do that, okay, as a group. कि मेरा project जो है 200 megawatt का है. So you can make one variation. You have to make at least 4 or 5 variations. There are about 20 variations. Okay, fine. The capacity utilization is 22%. Okay. Now, any questions there? 22% capacity utilization. Now, that's a normal capacity utilization of any solar project. It can vary between 22, 18, 19, 20, 22, 23, 24, but not 100% or 80%, 70%. As in the normal companies, they can operate at a very high level. Why? Any thought process come to your mind? In a case of a solar project, the company, the plant cannot produce at 100% capacity. Abdul, just guess. Huh? Which one? Yeah, you can elaborate on that. That's a good point. So, in the night there is no sun. Okay. And then, sometimes there will be cloudy time, and, we find that these plants operate at around close to about this percentage which I have mentioned here. And then, normally in the happens is there is always a degradation. As the plant becomes older, the capacity will going to fall from 22 to say 20.5, 20, 18. They change everything, they maintain such a way back to the level. The plant is old, the capacity of the plant to produce the power gets reduced over the time as the equipment becomes older. So we'll add this. We can have this thing that the plant will run at 22%, then there will be a 0.5% degradation every 5 years. Okay, so you can build that also in your answer if questions if you want, but maybe that's up to you. I have not added that. Okay, so annual generation is I'm just moving to the side of this thing. So to explain that, so this is plant size is 100 megawatt. Then hours in a year are 8,760. That means 365 days in a year multiplied by 24 hours. So that means total number of hours in every year which the plant can, officially run, but it will not be able to operate at less than that capacity. Now, so step one, now we know that, and the capacity is 22%, okay, utilization. And 1 megawatt is equal to 100 units, okay. 1 megawatt can be converted into 100 kilowatt, and 1 kilowatt is 1 unit. Okay. When we consume power in our house, so we always talk about units, how many units you are consuming. So that is a unit here. Fine. So then we multiplied 100 into 87. So we get, into 100 is the megawatt, and 876 is the number of total hours in a year. So that means the total maximum possible energy generation can be theoretically is 8,76,000. Is that okay? Okay. Then we have 8,76,000 into 22%. So this is 1,92,720 megawatt would be the total capacity of the plant, the utilized capacity. Okay. Then convert this to kilowatt. So that means that we have to multiply this by 1,000. So this will become the number of units the the unit can produce. Is that clear? We have multiplied by 1,000 because one megawatt is 1,000 units. Okay. Then so that means it is 1,92,720 units. Okay. So now we can convert this into, some people write in millions. So we divide this by 10 lakhs. So we get 192.72 million units. Okay. Sometimes the question is given million units. So we know that it is divided by, number is divided by 10 lakhs. So we get the million number. Okay. So now we come back here and see. So it is 192. The number given here, 122 million units. So that means we are here referring as million units. Okay. 192. So equal to number of units will be this whole multiplied by 10 lakhs. Then the rate per tariff is 3 rupees. That means this company is going to sell the power at 3 rupees per kilowatt. Okay. This is what the customers are going to be billed. Okay. Fine. So if we calculate the revenue, it will come to 578 million rupees or 57.82 crores. So we know that this is multiplied by this multiplied by 3, we get this many rupees. Okay. If we divide by crore, so we'll get 57 crores will be the total revenue. So net is that how much revenue the company is going to generate. It produces the power at the same rate, at the same. So that means the yearly revenue will be 57 crores coming out of this project. Is that clear? Okay. Any difficulty here? Any questions here? Okay. Now we go to the question. So this was required to understand how the nitty-gritty of how to convert everything. So now we come to the question. Okay. And move at the top. Okay. So just you have to be very careful, understand each and everything. Okay. Then I'll repeat whenever you find it difficult. So same greenfield is setting up a 100 megawatt solar power. Okay. And there is a power purchase agreement for 20 years. And then the capacity is 100. So ours again the same, 192.7 million units. 3 rupees is the rate. So that means the revenue would be 57.8 crores. Is that okay? Fine. So up to this we have already done. Now we come to the capital and operating cost, which is given in the question. The capital is like this. Now this question is already given in the Excel sheet also. So sorry, PPT. So you just can go there. So either way you can just look at the PPT. So this question we did last time. Okay. Okay, I'll come back to that. I think it's in a separate this. So let's remain in this. Let's remain in the Excel sheet itself. Maybe that I have prepared a separate, PPT which I can't share at the moment. Okay. Since you don't have that. Okay. So the capex is 250 crores. So company is going to spend 250 crores to set up this plant. Okay, fine. So this is the total project cost. So you can always change this also. You can increase. Suppose you make it 200, so you say 500 crores company is going to spend, or you can make it. Okay. Then the operation and maintenance cost is going to be 15 crores per annum. Now after the plant has been produced, started producing its product, so it has to be maintained. So company is going to spend 15 crores annually on maintenance, and this maintenance will go up by 3% per annum. Okay. So I have written 1.3 to link it with the formula. Okay. Fine. Total tax and depreciation. The depreciation is straight line over 20 years, which means 250 crores is the cost of the plant divided by 20, 12.5. It will be the depreciation. Okay. Then the corporate tax is 25%. And the discount rate, now the WACC of the company is 10%. The WACC is basically the weighted average cost of capital, both the debt as well as equity. Okay, and we have understood how we calculate the WACC in your earlier classes. Okay, but I'll just go back to that and explain a little bit later. But as I know that you understand. Okay, should I read how the WACC is calculated? What is the formula for calculating WACC, Sanvi? Do you remember? Okay, I'll ask Anushka. आपका speaker आप बोलो. बताओ नहीं आप बताओ. WACC. What is WACC? The WACC is, like suppose if I put a WACC here, the formula of WACC. Okay. Weighted average cost of capital. Okay, fine. So which is basically the, it is, yeah, tell me, the equity and debt. So these are the two components. Okay, I'm just going to say, okay, then you can, suppose equity is say 50%, okay, and debt is say 50%. Let's say a simple one, 50-50%, okay, and the cost of debt is how much? Say it is 9%. Fine. And the cost of equity, I am assuming it is 15%. But how do you determine the cost of equity otherwise? I mean, can you determine the cost of equity? Using CAPM. So you can use a model to calculate, the cost of equity. I'm not going to do the calculation at the moment, but I'll go through it. Okay. So using the CAPM model, which is the model which is there from last so many years, 50 years, okay, people have tried to, make some changes. And the formula which they came up became very and very difficult to understand and prone to a lot of mistakes being made. But this formula of CAPM is an outdated old model, okay, which is still universally being used. People understand it, it's very easy to explain, but it has many limitations. Okay, we are going to understand there are a lot of limitations that we use the right number. Okay, but let's understand the cost of equity is 15 and this is 9. So, and suppose the debt has, suppose the tax rate is 30%. So this is the tax. Okay. Now tell me what is the cap? What is the WACC? Just calculate. Do you remember the formula? So you can just tell me. Akshat, anyone? Yeah. Yeah. So there will be number here. So this will be 7.5. Okay. Then what will be the adjusted figure here? Do we make a tax adjustment here? Yes, sir. Yes. How much will be there? So this will be 1 minus t. So this will be how much? 7.5 कितना हो जाएगा? Oh, sorry, that's equally. Okay, sorry. So this is 9. Okay, sorry. So this is 9. 1 minus t. So equity is not tax deductible. It's basically it doesn't get any tax benefit. Okay, sorry, I moved to the wrong way. So this is 1 minus t. Okay. So how much will be this number? Huh? 6.3. Okay, I'm saying 6.3. Okay. And then we have the 50% component. So that means this will be 3.15%. Okay, fine. And we'll add 50 of this. So 7.5. So this will become 10.65. Is my calculation okay? Have you understood? That's the back. Okay. So we get a tax benefit on the debt cost, but we don't get the tax benefit on the equity. Okay. Why so? Any answer? Any thought on that? Tax में हम equity में क्यों नहीं करते 1 minus t? Why do you on a debt? Just give me one line answer.
Basically, when your debt is high, your EBT goes low.
No, no, just give me one line. Language. Why equity is not tax deductible? What it is equity is then? If it is not tax deductible, because on equity, what do you get? If you own a equity shares, what is the reward you get? Dividend. And if you are having a debt, what reward you get? Interest. Okay. So interest is tax deductible because it is dividend. No. So then what it is? It's an appropriation of profits. After you earn money, you declare among as a company, as a partners or as a shareholders. So the law says that you have to pay the tax first and then and if you distribute, you don't get any tax benefit on that. Okay. So dividends are appropriation of profit. It comes in the profit and loss appropriation account. Below the line, they say. So equity is reward and equity is dividend, and it comes below the line after you pay all the taxes. So it's an appropriation of profits and not an expense. Whereas interest becomes a cost to the company and it is tax deductible. So it reduces your tax liability of the company. Okay. So though your cost is 9%, but cost to the company is going to be only 3.15 because it reduces your tax burden. That's why that is always cheaper than equity. Okay. Is that okay? Is this clear? Okay. So coming back to this, so WACC is here given as 10% here. Now here the debt and equity is given. Debt is 175 crores and equity is 75 crores, and the percentage of debt and equity is given. Okay. So 250 crores and 100%. Of course, the WACC is given to you. We are not going to entering into calculation of the WACC. Okay. The debt terms interest rate is 9%, and so it comes to 15.75 crores based on the formula. We have the total, 175 crores is the debt and the loan into 9%, so it gives you 15.75 crores of annual interest installment. Okay. Then we go to the loan period is for 12 years. Okay. So the principal amount is 175 crores, so we can just check that. So which is okay, so this has not been linked, so that's why it's saying. Okay, so this is 175, which is linked to this debt here, and then divided by 12. 12 is what? The period of the loan. So that means the loan installment will be 14.58. Okay, fine. So so if you miss a formula, then you will not get a link, and your question can go wrong. So just to make sure that all the linkages are there, or you link straight away to this rather than making another entry here. So you should have kept it here and linked here, and you would have divided this by 12, so you'll get the answer here. Okay, fine. Now we make the calculations. Okay, what is the life of the plant? 20 years. So year 0, how much the company is going to pay money? 250 crores. Okay, this is going to be the outflow in the first year. There will be no revenue, no kharcha, nothing, no tax. Now, so we have the year 1. Year 1, the revenue is how much? So all the years the revenue is 57 crores, right up to 20 years. Okay, fine. So the O&M cost will be 15 crores, and then it will keep moving by 3%. Okay, so you can just go and check the formula. So it is getting multiplied by 1.3 progressively, and then your cost is going up. Okay. So this is, and then revenue minus O&M is your EBITDA. Okay, fine. Revenue minus the expense of maintaining the plant becomes EBITDA because there is no other cost given to you. Okay. Then we calculate the depreciation. Depreciation is coming right from the top here, which is being calculated here. Okay. The total cost of the plant was 250. Life of the plant was 20 years. So depreciation on straight line method is 12.5. Then we calculate tax. Now just look at the tax. Okay, how it has been calculated. So we are using the corporate tax rate 25%. Okay, and multiplied with EBITDA. Do you do that actually? You do multiply it with EBITDA or what? It is the PAT. On PAT you have to pay tax, isn't it? Normal course, it is a PAT on tax. For calculating the project, return, okay, we have to calculate the tax on EBITDA and not on the PAT. Okay, we'll understand that slightly more. So that's a catch here. So the tax is going to be higher. So you are not going to get any benefit of the interest what you are paying. Okay. Of course, you are going to get interest benefit in reality, but to understand how much the project is giving a return, you exclude how it has been financed. So the idea is, in this concept, is we are not mixing up this thing that how it is getting. So another person can use entirely his own money to run the project. One person can use 50%, another person can use 25%. In this case, the company has used 75%. Okay. So we are ignoring how the project has been financed by calculating the tax liability. Tax liability is 7.5. Okay. So if you calculate on PBT, I said PAT. PBT is on the PBT you calculate the tax, isn't it? And you get a PAT. So here, what we are doing is we are not calculating the benefit of the interest, which will reduce your tax liability. That's called the tax shield. So we are not considering the tax shield, okay, because we are judging how the plant is going to do, okay, irrespective of finance. So then we have all this money, okay, project cash flows we have calculated on the basis. So every year this thing. So then what we do is we calculate the present value of all these cash flows, okay. Okay, fine. So if I have to calculate, so we can just see the formula here. First of all, what formulas we are used. So it is basically the present value. So I can just recalculate again for you. So what we do is that we just NP, okay. Financial. So just pick up, write the rate here, and the rate is how much? What is the rate per back? So we are going to discount. We are going to calculate the present value of all the cash flows that the company is going to generate at the rate of that. Okay, fine. And then we are going to pick up all these numbers, which is going to be this, right from the first year. Okay, and then just highlight this and say enter. So we'll get the number 278.10. Is that okay? So this is the present value. So all these cash flows which you are going to calculate, which you have calculated. So I'm just calculating, if you get all this money today, how much the money you will get. All this money is given to you in hand. This is the present value of all the cash flows which you are going to generate and discount it at the cost of the back rate. And then how much money you have spent. Addition you are getting 28 crore. So it is not 5 because so here what we do is we can trace this formula. So it is now we include this 250. Okay, we minus this from 278. So we get NPV. Is that okay? So the company is generating if you spend 250 crores, you get a return of equivalent to 28 crores. You know that this project is positive. Now, how much return you are getting? You want to understand because your back is 10%. Okay, so it comes to 11.77% IRR. So how do we do that? We just pick up the formula and pick up all the numbers now, right from the beginning till the end, including 250. Okay, this, and then calculate. So you will get a 12% here, and if you just make it up to 2 decimal places, it's 11 points. So IRR you have already done, I believe. Have you done that? Just raise your hand if you have done it in your MBA or in your earlier. In this terms, you have done. So IRR. What is IRR? And what is the cost of capital? So is it okay? Is it okay? Is there any flaw in IRR calculations? Have you read that? IRR has a limitations, okay? IRR has a limitation. What is that limitation? So there's something called MIRR. Are you aware of this MIRR? Just raise your hand if you know that. MIRR, you know that.
In IRR, it assumes that it's cash.
Modified, yeah.
It will be reinvested at the same interest rate.
Huh?
In IRR, it assumes that its cash flows will be reinvested at its same interest rate.
Yeah, absolutely. But it is not true actually. So others are not aware of it. First time, but this guy knows what is your name? Sachin. Okay. Now, what IRR says that you are going to get 11.7% return. Okay. So, you know, they used to be a question always to MBA students whether which method is better, IRR or NPV. It's the NPV which is a better method, not the IRR, because there are some limitations to getting every year. It is getting reinvested at 11.7%. Now, every year you are earning something, okay, and it is presuming, this formula assumes that it is redeployed in this own, again this in this project, and you are not doing that. Okay, suppose you are not doing it. Okay, you are, whatever money you are getting, you are going to use for doing some other project. Okay, fine. So so that's why this formula assumes that whatever cash you are going to return or earn, they are getting deployed back in at the same rate. Okay. Now, how do we correct this thing? The answer is that what is your back here? 10%. Now, if a company has another project, okay, which gives a 9% return, will the company do this project? Because the cost is 10% and the new project which is going to generate only 9%, so it is not going to do. Okay. So that means this is the limitation. That means the company is going to get at least 10%, then only it will put the money. The money which they are getting every year, they are going to deploy at least 10%. Okay. The MIR formula assumes that whatever cash you are generating, that is getting redeployed at 10%, whereas this project is giving 11.77%. So it can, okay. So it will be, you know, like 11.15%. So that is called MIR. Okay, so we'll discuss that later. I'm not calculating the MIR at the moment. So MIR assumes that whatever the cash the company is generating out of this project, it is getting redeployed. Let's try, if I have not used it for long. So let's say that if we have the MIR here. Let's go to this MIR. Just go to the MIR. So this is the MIR. So it says that we need to first see all the values here. Okay. Then the finance rate is your 10%, which is the cost of this thing. And I don't know, there are two numbers which is asking. So I put 10 both. Let's see what we get. So we get 11% as MIR. If I'm right, then this is the number what we have got as the new number. Okay. So it is 11.59%. Okay. Fine. Because we are assuming now the cash which the company is generating is getting redeployed at 10%. And this project is giving 11.7. So the combined return is 10.59%. So still it is better than this thing. So this project goes through on this parameter also. Okay. Is that clear?
Yes.
Okay. So this will be the MIR. Okay. Fine. So this is giving 11.7%. So far, okay. Is there any question? Okay. Now the second part of the question. Okay. Now we know that the WACC is 10%. So project IR is greater than the WACC. So we have not added the MIR concept up to now here. So I just added in the class today. Okay. Conclusion: the project is financially viable. Okay. Fine. So now you can skip MIRR at the moment, okay, in your presentation. If you want, you can add it. If you have just gone through the theory and understood it properly, then you can add that. Okay. Then we calculate some more things, okay. Revenue was how much? 57 crores. Okay. So we are going to calculate the some more numbers here, okay. The CFATs, that means the cash flow available for the debt service. Okay. So the calculation is slightly different here, okay, fine. 57.8 crores. O&M is 50 the first year. The first year we are going to calculate the cash flow available for debt service and calculate the ratio. Okay. So EBITDA is 42. Then 12.5 is the depreciation. Okay. So we get EBIT. Then we reduce the interest and calculate the PBT and calculate the tax again. The tax is how much? 3.64 crores. If you know that there was on EBIT we are getting tax of 7.58. On PAT we are getting, so tax shield is 3.94%. So this we haven't considered for calculating the IRR. Why we have not considered for IRR? Because the IRR tells you this is the return you are getting. Okay. So how, as if you are financing everything of your own, there is no debt structure. Okay. Sorry, there is no capital structure. I mean, everything is financed through equity and how much return you are getting. Okay. Now, if you add debt, then you will be double counting it, okay? Because the debt is going to, fund your, okay? So the IRR will get, so you will get the debt, this thing, okay? So though you are going to pay less tax, but you are going to consider full tax for calculating the IRR. Is that okay? So then you got the tax as this thing. So we calculated now the CFAT. CFAT is your the revenue, the EBITDA minus the tax now. Okay. So which comes to 42.8 crores. Okay. Fine. 42.8 is the CFAT minus the tax. So you get this CFAT of 39.16. Okay. So the debt coverage ratio would be, your interest is 15 crores and your principal is 14 crores, which is given the top. Okay. So you add them up. So your total debt, total debt service is 30.33, whereas your cash flows is CFAT is 39. So how much you're getting? 1.29. Suppose the lenders are looking at 1.2, you say okay. In case if it is 1.3, you say it's less. Okay. Then we have to calculate the loan life, the debt service coverage ratio to find out whether the company is able to generate that kind of a return or that debt service coverage ratio equivalent to what is desired by the lenders. Okay. So your debt service coverage ratio is 1.29. Is that clear? Fine. Then it meets the typical lender requirement of say 1.2. Suppose the lender requirement was 1.2, so it is meeting. The first year itself is meeting. Okay. Fine. So then we calculate the DSRA calculation. This is the reserve. Fine. How much reserve they have to keep. So now in the next year D2, the original payment was 175 crore minus the first year installment 160. Okay, so 160 is your total outstanding principal after first year, and the interest is 14 and the principal is 14.58. So your debt service is this. So which means you have to make a debt service ratio of 50%, which is 14%. So the first year we don't calculate the debt service reserve account. It's only the year 1 when we calculate.
Year 2.
So this is what year 2, isn't it? Year 2. Okay. So we are doing it for year 2 here. Okay, fine. So you'll understand what is the reason for that. Year 1 we don't calculate the reserve. Okay. Okay. Now this is funded by the equity at financial close. That means the company has to maintain 14.5 crore rupees as money, which is going to be fine. Then this is the logic behind. Just read it, what is written there, or read it from your Excel sheet. Financing effects are excluded from the project NPV by design. Tax is calculated on EBIT and not PBT. Interest is not deducted for project valuation, therefore, evaluation or valuation. Therefore, the tax shield from interest is ignored. The cash flow remain the same, and hence NPV, IRR do not change. Okay. So this is the logic for that. Is it okay? Okay. So now the class exercise. Okay, so this is the question which I will be sharing this PPT. Okay, you can even take that he's taking photograph, so you can put it on a WhatsApp. This photograph. Okay, I'll share by the time she'll get the information there. Okay, I'll pass on this PPT to her roommate. So or I should do that straight away so that you get this PPT in your with your this thing. Okay, so this is only the question, not the answer. So I thought I'll just share the answer at the moment. So this is a class exercise. Okay, file name. Oh. Okay, I just shared this PPT, so you can just share. So in the meanwhile, I'm just opening up this file again. So as you get your PPT back, so you'll be given enough time. Okay, so just go through this. So this is the question. Okay, fine. So go through this question. A project financials and assumptions. A developer is evaluating a grid-connected solar power project with the following details. Capacity and tariff. Capacity and tariff. Installed capacity is 80 megawatt. Capacity utilization is 24%. Hours per year is 8760. The tariff rate is 3 rupees 20 paisa. Then the capital and operating costs are given. So capital expenditure is 220 crores and O&M cost is 12 crores and O&M escalation is 4%. Okay. Then the tax, depreciation and discounting. Depreciation method straight line. Useful life 20 years. Corporate tax 25%. Project discount rate is 10%. Okay. Then the financing structure. I have already shared the PPT. Have you got it? अभी आई नहीं? ऐसा क्यों हुआ? I'll just check. आपको मेल आगे नहीं आई? I've sent this mail. I'm just again sending it. Okay, let's go back. So the debt is 154 crores, equity is 62 crores, 66 crores. So this is this thing. Then we have the interest rate 9%. The loan period is 12 years. Repayment equal principal. DSRA requirement 6 months of the next year debt service. DSRA funded by equity at financial close. Required. Now this is the question which you have to solve. Okay. Calculate the annual energy and revenue. Okay. Calculate the annual energy, million units. Calculate the annual revenue. Then required project cash flows here. This thing. Prepare a text table showing for. So you have to complete for whole years. You have to say maybe that is 1 to 5. You can ignore that. Revenue, O&M cost, EBITDA, depreciation, tax, project cash flow. Then we have to calculate the NPV, IRR, the same thing what we did, and then calculate the CFAT for the year 1, then the DSR, this thing, okay. So then you calculate the DSR year 2 debt service, compute DSRA requirement, show how when DSR is funded. Then the conceptual question, explain why interest and tax shield from interest are excluded from the project of NP calculation. So which what I have written to you. Okay. Now, so these are, if you look at these are the first is basically the question itself. Okay. So you have the installed capacity which is given. Now you can make a new variation of your own. So this is just an example. Okay. So you can make it from 80 to 100 and solve the question again. Then the project cost. So it is 2. Any cost you want as a group. like I have assumed for say one group as 275 crores. Then capacity utilization is 24%, you can use 23%. Tariff 3 rupees 20 paisa is in the question. Then operation maintenance is 12 crores in the question. Then it is increasing by 4% every per annum. Then useful life or straight line method is 20% every year. Okay. Then the corporate tax is 25%, you can assume any. Debt repayment equal in principle, so that is there. Then the period of loan is 12 crores, interest rate is 9%, equity is 66 crores, WACC is 10%. Okay, so you can make changes, whatever you and redo the question again, this which I have mentioned in an Excel sheet. Okay, so and, so I'll just show you this first. The first one which I so this is in an Excel sheet, okay, which is not with you at the moment. Because what I have done is, why I'm not sharing this file is because I'll be sharing the answer of this first this thing. Because in the second set I have made a linked file. So what I will choose, okay, I'll take that and calculate the answer. So you first calculate the answer yourself, make a presentation, then we'll find whether the answer is correct or not. Okay, based on this linked file, you change any other parameter, the answer NPV and every IR automatically calculates. Okay, fine. So this is the linked file. So then of course this is the second term. So what I have done is, so similarly, okay, so you have to prepare it like this only. Okay, so like installed capacity, then you have to calculate the kilowatt like this. Revenue collection comes to 53.82 crores on the basis of question which I have shown you. Okay, you have got the PPT. So this here it is coming 53.82. Then the capital expenditure is minus 2220. Okay, then operating cost is 12 crores given in the question, and it goes up by 4% every per annum. Okay, then the depreciation, okay, then the discount rate, okay, then interest rate, okay, and then we arrive at basically these numbers. Okay, I was just wondering ये कहाँ से आया, just let me just see whether I have linked to the formula. Okay, so it is 1.04 I have multiplied straight away, okay, instead of putting 1.0. So we have the O&M which is going by 4%, then EBITDA, then depreciation, tax, and then we calculated the project IRR. For this sample question, the NPV comes to 45.93 and IRR comes to 13.15. Similar what I have done in my earlier this thing. Then the same thing, all the questions have been answered. So this is the question which I have shared, already shared the PPT and Excel sheet which I have shared we did in the morning. So you have to use the same template. Okay, here also I have used the same template for solving this question, because since I am not sharing this because it contains the answer also for the what you are going to do, and so that it is a ready-made solution you get. That's why I am not sharing. Okay, I can share it without this. Okay, if you want this file. Do you want this file to be shared? I can remove this link file. Okay, what I do is I will save as a new file and say this is for the class, I can say just. Okay, so I open this file class and just delete the link file from here. And just even delete the second question which I'm going to do later. Okay, so this is the file. Okay, so I'm just sharing this answer also with you for the question which I have given to you.